We move forward now to our first panel on the global market economy. Is it broken? And from one of the giants of industry to one of the giants of my own profession of journalism, Martin Wolf is the Associate Editor and Chief Economics Commentator at the Financial Times. But I think he is very much more than a journalist. He is an institution. You have a distinguished lineup of honorary doctorates, and I can tell you, because I don't hold any, they don't come easy to the likes of us. Martin, I ask you to come on here and introduce the members of your panel. Thank you very much.
That was just about the most intimidating introduction I've ever had. We have an hour and not exactly a compact panels, but we're going to do our best. Let me introduce first the members of the panel. First, Jeff Immelt, who you just heard from, who will sit at the end. Then Lord Davies, whom we've also just heard from. Then Ian Davies, who's for one more day, I'm told, the Global Managing Director of McKinsey and Company. Then, very good friend of mine, Professor Kishore Mahbubani, who's Dean and Professor in the Practice of Public Policy at the Lee Kuan Yew School of Public Policy, intellectual, author, and diplomat. A very rare combination, and quite remarkable. Then Hélène Ray, who's Professor of Economics at the London Business School. And then Andrew Scott, who's also Professor of Economics. And finally, this is alphabeticism. I always complain about alphabeticism because I'm a victim of it. But Mr. Walsh, Paul Walsh, who's the CEO of Diageo PLC. I think this is a very appropriate panel, particularly here, because it gives me the opportunity to say, looking at the mess of the world economy at the moment, what on earth have you been teaching all these years? Particularly to the people who went into our wonderful financial sector. Now, the question of the panel we'll be confronting is the global market economy broken? And unfortunately, and I do stress, unfortunately, I fear that there's nobody on the panel who's going to say yes, and maybe left to me at the end. But it is worth remembering where we are. First of all, I think it's fair to say that virtually nobody expected the carnage we've seen in the last year or two. Second, we are in the deepest world recession since the 1930s, green shoots or no. Third, according to the IMF's Global Financial Stability Report, the overt support for the global financial system offered by the United States, Europe, and Japan is $9 trillion, half of it guarantees. But in fact, of course, effectively after October, the liabilities of the entire Western core financial system were socialized. And in addition, we are in the midst of the most heroic fiscal and monetary policies outside wartime in history. There has never been anything like it. So the question that the panel has to address is, what does this all mean for the future? Is the global market economy broken? And if not, what needs to be done to make it work rather better? We don't want this sort of experience to be repeated. How, in other words, to take Jeff's introduction, do we reset the market economy system? And I'm going to start with you, Ian. You have a grand total of 3 minutes to answer this question.
Well, thank you, Martin. I don't think the market economy, the global market economy, is broken, at least not yet. I think we're at quite an early stage, actually, of the stresses and strains. But I think the fundamentals of the market economy are accepted virtually everywhere in the world. I'm particularly worried about the financial side of it, and maybe Mervyn and others can talk about that. But really, there's no legitimate intellectual or practical alternative, at least as I see it. Now that's not to underestimate the stresses and strains, but I see this as fundamentally a crisis within the global market economy, not a crisis of the global market economy. It could change if this goes on for another 2 or 3 years, which it well could do. I think that political tensions, particularly in countries that we don't typically talk about, in Eastern Europe, in Latin America, and parts of Asia, I think the social and civic strains could become intolerable, and then we might see something. But right now, I think it's tremendous stress rather than a breakdown of the global market economy. I would just say there are many market economies. We talk about capitalism and the market economy, but if you're in Italy or Korea or Chile or something, you're talking about very, very different manifestations. So this talk about the market economy or capitalism, I find, is intellectually very misleading. There are many, many different types of market economies. I would just pick 3 quick points to make before I can conclude. I absolutely agree with what Jeff was saying. I think we are going to see a move anywhere towards more of what I call state-influenced market economies. I don't like this Anglo-Saxon versus French model. I find that intellectually lazy, but I think it's inevitable that virtually everywhere in the world, I think government is going to be more of a player in the design and control of market economies. I absolutely agree with Jeff on that. And you could say that's always been the case in different parts of the world, but I think the role of the state, the role of government is one. Secondly, I think Mark's point is right, we're going to have to look at some of the basics of economic and financial theory. I personally am the camp of stakeholder capitalism. I know it sounds a bit of a jargon, but I think that's going to come back into the intellectual forefront, and I do hope that the business schools will begin to take a lead in this. I think the financiers and Black Scholes and all the rest of it have been far too dominant in business school teaching. Business needs to teach more about business. And then the final point I would make in terms of things I think that do need to change for the global market economy to achieve is this issue of incentives. At the moment, incentives is focused on outrageous banker bonuses, but and I can see this conversation running out of hand. Incentives of capital, it's incentives for society and for citizens, it's incentives for governments as well as incentives for staff and employees. And I hope that the debate about incentives becomes a holistic one, which provides the right incentives to all the different stakeholders as we reset our ideas of the global market economy.
Thank you very much. Beautifully to the point, and I think we must come back to the question of shareholder value, which is obviously one very important question that comes out of this crisis. Kishore, how does it all look from Asia? Triumph of the Asian model, decline of the West, great rejoicing.
Well, Martin, in your email to me, you asked me to be provocative, and as a good Asian, I always accept instructions. And I'll be provocative. But as an Asian, I also have to apologize in front for my provocations. So let me make 3 points like Ian did, okay? I see basically 2 dangers and 1 great opportunity on the global market economy question. The first danger is that there is a kind of incestuous, self-referential, and often self-congratulatory dialogue among Western minds about the state of the world. Now, this is a bad habit that the West has accumulated over 200 years of universalizing the Western condition on the rest of the world. So you have doom and gloom in the West, so there must be doom and gloom in the rest of the world. But the remaining 88% of the world's population, 12% lives in the West, 88% lives outside. For many of them, prospects have never been better. And if you look at the point, on the point of view of 3.5 billion Asians, there's never been a better time in history because as Martin and I discussed in Hamburg a few weeks ago, Larry Summers gave me the statistic, we're going to see a 10,000% improvement in living standards in one lifetime in Asia. So they'll find this question, is the global market economy broken? A very strange one, because they believe that the next few decades will be among the very best. Just to give you another statistic, a 10% increase in median income in Asian societies leads to a doubling of the middle class. And you'll see an explosion of middle classes all over Asia, which is why your wealth managers ask you to invest in Asia, which is why Jeff Immelt has to talk about a China and India strategy. The second danger is this. The West is losing its economic power, but wants to maintain the Western domination of the global economic order. As Mao Zedong would say, this is a major global contradiction. I mean, the most egregious example, of course, is the fact that to become the head of the IMF, you must be a European. To become the head of the World Bank, you must be an American, and 3.5 billion Asians don't qualify. Now, to compound this problem, Western economies have gone from being competent, from seeing competent economic management to incompetent economic management. I mean, look at how Alan Greenspan treated derivatives traders. He said there's no need to regulate them. They're all professionals doing their work. Why should I, as a regulator, come in? So the real danger that the global market economy faces is the combination of Western domination and Western incompetence, and this, believe me, is a fatal combination. Now, my third point, the opportunity. Yes, we also face a great opportunity today. Billions of new Asian minds want to participate in the global market economy. There has been an explosion of cultural confidence, and all the new Asians want to be the capitalists of tomorrow. So if the West and Asia can work together, we could possibly have the greatest economic growth in human history. This is therefore the moment to revitalize and conclude the Doha round. But here again, the problem is that Western negotiating position in the Doha round are determined by narrow and short-term interests. The interests of a few thousand cotton farmers, 25,000 cotton farmers in America can derail a global agreement that could help 6.8 billion people. To make matters worse, Western populations are beginning to lose their faith in trade liberalization. The US-Colombia FTA is dead, even though it serves American interests. By contrast, the largest FTAs in the world are being concluded between US and China, ASEAN and China, 1.7 billion people, ASEAN and Japan, ASEAN and Korea, and soon ASEAN with India. Billions of people entering new FTAs in Asia while the West is walking away from them. So in conclusion, just let me emphasize that we stand at the dawn of the most promising economic era in human history. But to get there, we need a massive retooling of Western minds. They've got to see that, yes, the West has been a large part of the solution to global problems in the last few decades, but increasingly it is now a large part of the problem too. And until and unless the West realizes it is a large part of the problem, we may actually find a situation where the global market economy actually becomes endangered. So I hope, Martin, that was provocative enough, as instructed by you.
You didn't disappoint me at all, Kishore. And to summarize it very quickly, in response to the question, capitalism, or the subject of capitalism, isn't the problem, the West is the problem. I think that's a very nice starting point for our discussion here in London. As well, imperial capital, as you forbore to point out. Hélène, what is your answer to the question, is the global economy, market economy, broken?
So my answer is also no, but let me come back a little bit on the word global. And I will look at the global market in two ways: international trade flows on one hand and international financial flows on the second hand. So international trade flows have fallen like a stone. Worldwide, we haven't seen such a fall in international trade flows since the 1930s, and the numbers are really beyond belief. Year on year, merchandise exports of Japan, for example, have fallen 40%. We have similar numbers for Germany. So what is going on here? Well, I think one of the big explanations of this dramatic collapse of international trade is that in uncertain time, we know that the demand for durable goods and the demand for investment goods is going down very steeply. And in our world where there are global supply chains, that means that if the demand for final good collapse, the whole global supply chains shut down. So this leads to dramatic collapses in international trade flows. That's the bad news. The good news is that when final demand will pick up, we should see, in my view, global trade flows climbing up very quickly again. We should see that, unless we have some politicians around the world which give in to protectionism. And there are lots of calls in various political systems around the world for increased protectionism. We know this has been a disaster in the 1930s, And we just have to hope that this time around, politicians will not give in. The key country there is the United States. If the United States is into protectionism, everyone will retaliate. And then we are in danger. So that's my view on international trade flows. Now, international financial flows. Well, historically, one of the impediments to capital flows across countries has been information asymmetries. Countries did not invest too much in other parts of the world because they didn't know too much about them. Now, recently, this has changed quite a bit, but you could say that for asset-backed mortgage securities, this has changed for the worse. And what we have seen in the current crisis is massive capital repatriation, also complete collapse of international financial transactions. The only assets which have held their own are, not too surprisingly, US Treasury bills and US short-term government bonds, which are simple instruments, liquid, which have a safe haven property of the US dollar, and which build on the reserve currency status of the US dollar. So this change in international investment patterns that we have seen in the past months are absolutely dramatic by historical standards. By the way, the US net external position has, which was about minus 15% of its GDP, so minus 15% indebtedness of the US vis-à-vis the rest of the world, has recently been down to minus 40% of US GDP. So we have very dramatic changes there in international financial position. So what does it mean? Looking forward, I see much instability in international financial markets. Why? Because recent years have been built on the China-America economic relation that was excess saving in China, excess spending in the United States. Now, I can see China saving a little bit less, but still saving. I think I do see the US spending less. So in other words, I can still see, looking forward, a world with big savers. China, Germany, which had just passed the balanced budget rule, and potentially Japan to some extent. But I do not see the big spenders going forward. I think spending will be cut back in the US, in the UK, etc. So I can see a world where the dollar is a little bit under attack because of uncertainty on the inflation outlook, because it is also very dependent on emerging markets, central banks still increasing their reserve holdings and maintaining the dollar share in this reserve. And this dollar share has been very high. So I would conclude that this crisis has been redistributing some cards and probably making the world, at least the world of international financial markets, a lot more multipolar and also a lot more unstable.
Thank you very much. There's one particular point that you make there which I think is worth underlining because it's a figure which I had pointed out once or twice, but I don't think it's understood well enough. If you look at any of the major countries of the world, in the developed world now, the private sector is roughly saving 10% of GDP more than it's spending. That's true everywhere. That's an extraordinary situation. It's unprecedented, certainly in the post-war period, and it is, of course, the counterpart of these gigantic fiscal deficits. So if you're thinking about the future, one of the interesting questions is how that adjusts. And so I think Hélène has raised that issue, and it's a very, very profound issue about the future of demand in the so-called green shoots world. It brings me perfectly to Andrew.
Thank you. So you asked this question, is the global market economy broken? I want to do that terrible academic thing and try and define the terms, but I assume you don't want that. So I guess the answer is yes, it's been broken. But the great thing about the global market economy over history is it rarely gets broken and rarely mends itself. There's a constant change between the balance of markets and regulation. There's a constant change as to where that growth will come from. And I agree entirely with the previous point made that perhaps more growth is going to come from outside the West, but also outside of the West, their model of capitalism needs to change. China, the Middle East, as Hélène has pointed out, needs to shift a little bit away from savings and focus more on its own financial markets and its own financial growth. Martin, you asked us a number of questions in email beforehand. One was this a crisis of capitalism or a crisis for capitalism? And I say one of the things that I often feel when asked to talk about the crisis, as a macroeconomist, I get out a lot more than I used to these days. And I don't want to trivialize the crisis we're going through. This is, after all, the biggest financial crisis we've had in terms of dollar trillions. it may be the worst recession for 70 years, although I'm not quite sure on that one yet. And I know as a macroeconomist that I study business cycles and booms and recessions are temporary, they come to an end. So I know I may be trivializing this, but I can't help feeling that just as in the good times, when the booms were happening, when the bubble was happening, everyone around saying it's different this time, here we are in a recession doing exactly the same trick. Oh, it's different this time. The future will be fundamentally different. There will be many changes, I'm sure, but I think just as the good times, in the bad times, we may be exaggerating how epoch-making this period is. You also asked whether it was a crisis within the financial sector or for the broader economy. Obviously, when the financial sector goes down, it has enormous implications for the rest of the economy. The rest of the economy is going to have to get used to a higher cost of capital, the return of risk in people's planning, a higher risk premium, and possibly an aversion to debt, given the problems that it's caused. But ultimately, I think the problems are those within the financial sector. I think there are huge amounts of work being talked about the myriad problems the financial sector has. One of them, I think, perhaps, is in a sector which doesn't really get the benefit of patent protection. Financial innovation happens very, very quickly and very, very fast. And because there's no patent protection, whoever innovates, suddenly it's picked up by everyone else. Not always in the most safest or commercially viable form. And that speed of innovation, the perhaps aggressive way it's rolled out, also means there's massive problems with corporate governance and senior executives understanding these products, regulators understanding them, and actually trying to monitor them. And that may be something structural rather than specific to a particular set of problems. Another question you asked, Martin, was about the future of globalization or what the crisis means. Clearly the crisis is not good for globalization. We've seen already a return to some form of financial protectionism with money getting pulled back. We've seen, obviously, threats over trade as people worry about employment. But actually, I think globalization was having trouble before this recession. We saw the World Trade Organization, which has been in existence for well over a decade, still has not yet managed to complete a single trade round. We saw before the crisis already rising problems about immigration. I think this taps into a broader issue about regulation. Intellectually, one of the biggest trends the last couple of decades has been the rise of behavioral theory. The rise of efficient markets, I think, was a longer-term story. The rise of behavioralism has been important. And behavioralism says people don't always act in their own best interests, which, of course, is a calling card for regulation. I think also, if you look at the last couple of decades, we've seen globalization and information and communications technology really stress the advantage of deregulation, of governments getting out of the marketplace. If you look at the big trends the next 20, 30 years, I think it's going to be the environment and aging economy, as has already been mentioned. I think what's important about both of those is they require re-regulation. They require government intervention to solve the problem. So I think there has been a massive shift in the justification of government intervention over and above financial concerns.
I think that underlines what seems to be a shared theme and will be very comfortable to the Asian perspective, I think, that government is back at least as a full partner, and being given the nature of government, it doesn't tend to remain in that rather humble position for very long, given the power it has. So the last word in the panel, at least in its introductory statement, is for you, Paul Walsh.
Probably coming along with a surname Walsh here at the end, so all the good mistakes have been made. I would pick up two things. First of all, it isn't broken, but my oh my, if we look back 7 months, I think you may have got some very different responses from the panel, because we teetered on the brink of what I thought was a total meltdown. I think a lot of it is to do with how governments and industry behave going forward as to whether we can build our way out of this particular situation. For example, we talked about trade. There's been a lot of rhetoric in the last G20 round about avoidance of protectionism. Here as we speak, governments are introducing protectionist policies. We've got a meeting coming up in Italy at the G9. We'll see what comes out of that. But I think if there is a real stall in liberalisation of trade, that will be a huge setback. Given increase in unemployment in many developed markets, you can see how there will be a huge cry for job protection. I think that, over a medium term, would have the impact of constraining capital investment, in those markets. So I think we've got to be very, very cautious of the laws of unintended consequence as we come out of this situation. But, you know, we have seen these bubbles before. Go all the way back to the tulip bubble, the South Sea bubble, the tech bubble. We've now had a credit bubble, where credit was too easy, it was too cheap, and we are bearing the consequences of that. I think that the final thing I would say is that I think there has been and remains a crisis of confidence. If we just look in the UK, most consumers who still have their job, and I realise that's a big caveat, are far better off than they were a year ago. But they still do not have the confidence to spend at the levels that they used to spend at. And I think until some of that confidence returns, I think we are going to bounce around the bottom of this trough. And if that period of bouncing around is too prolonged, then I think we risk a further switch back into economic crisis.
Thank you very much. Your opening about where we were a few months ago reminds me, I just read a fascinating speech by one of the Fed governors who cites a remark made apparently by the chairman, Ben Bernanke, informally in very early October. And he was asked, I presume by some legislators, what would happen if certain actions didn't take place. And this was over the weekend. And his response apparently was, well, on Monday, there won't be a US economy. So I thought I was rather taken back by this. It certainly indicates a level of hysteria. Let me follow up with some of the comments with the people who made the keynote speeches. I'd like to start with you, Jeff. There was a particular comment from Ian about shareholder value maximization, and of course your predecessor has been reported as having made some remarks about this. Do you see, it follows on from your earlier remarks, this is a watershed in the way in which companies like yours will be managed, and how will, in particular, will the changes, what changes do you envisage in your relationships with the analyst community, the banking community, who were in fact, of course, driving a lot of that behavior?
We don't worry. Look, I mean, investors own the company, investors are important, the analysts remain important. I don't want to be naive to think that that gets diminished in value, you know, but let's look at it in the big picture. The S&P 500 is below today where it was in 1998. We're in a 10-year bear market, right? In the decade of the 90s, GE earned cumulatively $65 billion. This decade, cumulatively, will earn $175 billion with cash to match. But the stock is lower today than it was in 1999. So it's disconnected in some ways with the underlying cash flow and earnings of the company. So I think for a business leader, I guess the best lessons, you know, I hate to be this trite, but you know, in many ways, the way that Buffett talks about Berkshire Hathaway is kind of the right way. It's that you want the people to understand the strategy of the company, that in most GE businesses, we're making 20-year decisions in aircraft engines and gas turbines and the investments we've made in India 20 years ago. And you want to have the investor base that supports the long-term vision of the company. And so how that gets changed in the future, I don't know, but we've got to be honest with the fact that for a decade now, people have not favored equities versus other. We've had cycles. You know, clearly we're in a low cycle now, but this is not just a 2007, 2008 trend. This is a longer-term trend. So we need confidence, we need long-term view, and you need investors that are aligned with where management wants to take the company.
Would you agree that the West has become the problem? Have we failed?
You know, look, I think Kishore is provocative, right? The problem is, I know too much, right? you know, in other words, we've been going to these places for a long time. I think that China and India are immensely appealing, particularly if they can develop their own economies. You know, their own domestic consumption would make these places incredibly important. So I think the primary thrust that says the growth in China and India over the next generations is going to be significant, and that is a massive opportunity, and none of us should be negative on that. Is absolutely true. I just think the one thing we all should learn is the second you become arrogant in this world, you die. It's a brutal world on arrogance of all kinds, and I just think China and India are still going to have to work hard to be the kind of economies they need to be over time, just like the US and UK and the European economies are going to have to work hard as well.
Can I ask a question for you, Mervyn? A lot of people have expressed their concerns about protectionism. You'll now have the pleasure of dealing with this in government, in this Lord Mandelson's fiefdom. And
I was wondering how long it was going to take you to say that.
Yeah. Any journalist is amused by in this country we not only reshuffle cabinet ministers, we also reshuffle entire departments to suit the whims of cabinet ministers. You don't need to comment on that. Protectionism, how serious a danger from your standpoint is it? Many people feel that we've actually, particularly in finance, this has already been mentioned, because of the rescues, we've got a long, long way towards a highly segmented world financial system, and that may well be a harbinger of the future elsewhere, particularly given this incredible collapse of trade which Hélène has commented on.
I think, you know, we've all said that I lived in Asia for a long time. You look at the opportunities in China and India, but you look at markets like Indonesia, Vietnam, you know, wherever you go, there's opportunity in business. Paul mentioned it. I mean, there's a fantastic future ahead of us, providing we don't screw it up in the next few years. There's, you know, we've taken hundreds of millions of people out of poverty in the last few years, and that's been the good side of all of this. You know, a lot of these societies have advanced. But this crisis is so profound that it has resulted in every country suddenly protecting itself and taking measures. We've seen it in the US, we're now a flavour of it coming out of China. If we are to move into serious protectionist measures by countries to protect themselves, then I'm afraid the future is very bleak. And so it is absolutely critical that all of the world leaders, but also the business, speaks up with examples. We need to name and shame those countries and companies that are doing bad things, and we need to make sure. I think it's a real danger, but I'm an optimist. I think the new Indian government seems to be very keen on a trade deal. I think the challenge is going to be Obama and Congress. You know, how does he get that through? But I think the other danger at the moment is the second or third week in October last year was probably the biggest test that we've had probably in centuries. The whole system nearly fell over. And if we'd had 10, maybe 15 of the major banks falling over, the impact of that for our society and for our children would have been so profound. We came near the edge. But what concerns me at the moment, apart from protectionism, is that a number of the banks are talking as if nothing has happened, as if we're back to normal, we're now going to pay our money back, big bonuses are back, and we don't need regulation, we don't need to learn any lessons. In my view, we do not need a European solution, and then a US solution, and then a different solution for the rest of the world. We're going to have to get everyone together. We need an architecture for the financial services industry. We need to fix it, and if we don't fix it, then a combination of protectionism and the next financial crisis will be so profound it'll make this look like a practice reversal.
Thank you very much. I knew we could get you suitably gloomy in the end, despite all that optimism in your excellent speech. I'm going to take questions now. You already have an opportunity to address a panel of this caliber. So, and I'm sure you've all been primed, as many of you were here, to ask penetrating, brief questions. Say who you are, say to whom you are addressing the question. I'll take a few together and then allocate them among the panel. So anybody who wants to ask a question of anybody or all of the panelists on any of the subjects addressed, or indeed any other thing. God, they are very shy. Very, very shy. Somebody, gentleman there in the middle. Please stand up, it would help, I think. And please start thinking of your questions.
It's working? Yeah. Thank you. Cal Chandokis from EasyJet. We've just been through a 5-year planning process. And one of the questions we struggled with was, for the next 5 years, what is the biggest threat? Is it inflation in response to all of the money governments printed, or is it deflation in response to this excess saving rate we've seen? I think joining the panel, we want to pick that up. Thank you.
I'll actually take that to the panel, and while you all think of further questions, I think since we've got a paid-up macroeconomist on the panel, we should start with Andrew. And the answer, of course, is yes, isn't it?
Both of them.
Yes. There is a two-handed economist.
I mean, I think one thing we know is there's massive uncertainty around, and that makes this a really hard question to call. You look at the monetary trends, you look at liquidity in the financial system, it's huge, which worries everyone about inflation. You look at credit in the broader economy, and it's collapsing, which makes everyone worry about deflation. I think all we can do is look at the experience of Japan, which is into the second decade of its financial crisis. It's had a huge ramp up of fiscal debt. It's had a massive increase in liquidity and continues to struggle with deflation. In fact, although it's tried to create inflation, it's failed to do so. So I'd say empirically that makes me more concerned about deflation in the next 5 years. Of course, what's different this time around is there's so many countries in the States, so they may collectively try and inflate their way out. But I think the inflation threat is there, it's overstated, and it's more of a medium-term than a short-term issue. So it's a 5-year issue.
Wouldn't you have to admit, as a macroeconomist, that the one thing we all assumed was easy, the one thing everybody thought the technology for was perfect, was creating inflation. And it was a trivial problem, and yet you're telling us that here is the second biggest country in the world with a properly functioning system, and they failed to manage this simple task in 20 years. Can you explain this? But it is very relevant to what's going on and the exit strategy for where we are now.
It is, I think, goes to heart of what, I think there's many things one can complain about economists not understanding, but understanding that the financial system, the banking system, having helicopter models of money is one of our major weaknesses. I think that's why we cannot understand it. When something goes wrong in the banking system, it's a very deep, deep problem, and I'm not sure we know the answer to that, so I'm ducking it.
Hélène, do you want to add something on this?
Yes, so I would also agree that if we look at the inflation risk, it's more a medium-term risk, and that the immediate risk is more on the deflationary side, simply because of the weakness in aggregate economic activity is so large. Now, why is it that we have these two things? Well, we have these two things because in the short run, we have this huge amount of liquidity. Remember that the Fed has tripled in the size of its balance sheet, but this cash, this liquid thing, is not finding its way yet into the economy. So we have this paradox of having a massive cash liquidity increase in the numbers, but no credit coming out of it. Usually, the more you have cash, the more you have credit. Now the credit multiplier is broken. There is this money doesn't find its way into the economy because people are holding massive precautionary amounts of cash in banks and also in corporations. So once the economy picks up a bit and we do see a little bit more of this cash flowing into aggregate economic activity, that's where the inflationary risk will start to pick up. And there we have really to watch for the exit strategy of the central banks. If we see that they manage to decrease the size of their balance sheet quickly enough by selling back the assets that they have on their balance sheet, possibly by tightening the interest rates, which is a tricky thing for them to do, if we manage that they have a credible exit strategy, then they will have inflation under control. If for some reason we see more political influence peddling with central bank independence and a little bit of bargaining power between Congress and the Fed, say, going towards the Congress, then I would put a higher risk on the inflationary perspective. So I would really watch the political game between the central banker and the politicians on one hand, and also whether they find it easy to shrink this huge balance sheet quickly. And I will update my beliefs based on that regarding whether inflation will pick up or not.
I think the two conclusions you gave, it's a time horizon question, and there's massive uncertainty, because essentially we've never done this before, certainly not at the world level. So you're watching a remarkable experiment in which people will be writing about for the next 100 years or so in monetary history and practice. I sometimes think that the financial system did the whole thing simply in order to give economists PhDs for the next half century. Any further questions? Okay, somebody I couldn't see here? Yes, please. Sorry.
Good morning, John Denbitz, alumni of London Business School and chairman of a number of companies. The panel has spoken extensively of the prevailing circumstances as it impacts on government and as it impacts on very sizable, large multinational corporations. But the panel also made reference to the fact that the engine of an economy is its small and medium-sized enterprises and its entrepreneurial activity. Credit, debt financing is being sucked out, oxygen for small companies has been sucked out, and large companies not helping by imposing very difficult credit terms on their suppliers. How is this situation going to square itself for the future?
Thanks. Sandy Lahuja, London School and Head of Infrastructure Investment Firm. Question for Jeff, Mervyn and Kishore. Kishore, starting with you, you said that there's a lot of opportunity in Asia. Last 7 years I've been hearing Indian finance ministers coming to the UK and talking about the level of infrastructure investment required goes up, and it goes up by $100 billion every year. So why capital, all this year we can see too much capital in the system, why the capital has not matched the level of investment, capital investment has not gone alongside the level of investment required.
Thank you very much. There was one other question. Yes, the lady here. Yes. Sorry. Okay, you do it, and then we'll come back to you. Okay. Yes, give it to that lady. That's all right. We'll come back to you, I promise.
Right.
Yes, that's right.
Butane Group. When you're talking about protectionism, you keep mentioning the United States. But having worked in a lot of developing countries, I can tell you that most of the barriers are raised not against the United States, but against China. So can you talk about what policies the world can pursue to deal with that issue?
Okay, can we start, I'll start with you, Ian, if I may. There may be others who have things. The problem of credit, credit flows to small and medium enterprises, and the starvation of their businesses, and therefore the starvation of growth. How serious an issue do you think this is, and what might be done? And then I'll ask Mervyn the same question, which is obviously in your field.
Well, I think it's a huge issue, and it's probably the biggest impact on unemployment, by the way, is good companies going under because they don't have finance, and that's one of the big drivers of unemployment. By the way, it's not just a UK problem. If you go to Central and Eastern Europe, it's almost impossible to get credit finance, let alone trade credit finance. Many companies have got orders but literally cannot export. So I think it's a massive issue. I don't know what the answer is, I'm afraid, because this is an issue about the banks and liquidity. At the moment, we know what's happening there, and I don't think regulation can solve it. I think there's a huge opportunity for banks and the SME sector, and I'm just hoping that market forces will, in the end, it's very profitable business, lending to SMEs if you can do it. And maybe, I think trade credit guarantees are coming in. Germany has been very active, as is Russia, on trade credit guarantees. Maybe you might have a point, maybe governments can offer some sort of credit guarantees, but I just think the market's going to have to sort this out. I'm afraid there's going to be a lot of pain amongst good small companies because they just can't get the money.
Mervyn, the question I'm going to make rather more pointed, and I'll focus it at home, particularly given at least one member of the audience who will not be mentioned. The British government owns half of the banking system. As far as I'm concerned, the only purpose of owning these people is to get them to do something useful for a change. And supporting small and medium scale enterprise would seem to be one of their core functions. What on earth are you doing?
I always knew there was a problem coming on this panel in Martin.
I think we've got lending targets in with the banks, so 44 billion of extra lending has been committed to by the banks. So I think that's the first step. I think that this crisis has exposed a number of issues. I think it's the trade credit market disappeared overnight. Small companies, SMEs, rely very heavily on trade credit, and the moment it started raining, you know, you're in your house and then the insurance company says it's raining, but we're withdrawing the cover on your house. That has had devastating impact on SMEs across the UK, number one. Number two, we've got to recreate an ICFC 3I type institution that can put equity into small companies. At the same time, we've got to look at the future and structuring of the export market, ECDD, etc. I think the banks are behaving better than they were. They had a huge shock. At the end of the day, these companies nearly went bust. So it's had a huge impact on them. I think they're now beginning to get back to ordinary lending again. But I think there has to be a realization that the cost of credit, the cost of capital has gone up. And SMEs, at the end of the day, are the lifeblood of our economy. And what we are making sure is by region, by industry, that the banks are serving those companies. So we're monitoring targets on a weekly basis. It is getting back to normal, but as I say, it's also exposed a number of other issues which we're going to have to address in the coming months. And we've made a commitment that we'll have ECDD and some of these other things done by the end of the year.
I'm going to have a couple of questions for you, Kishore. One, if you want to answer for the Indian government on why, in fact, it's so incredibly difficult to invest in India. I might ask Jeff the same question. And the second, which I think is really interesting, since you present this, sometimes this picture of Asian harmony. As you know, everybody is terrified witless of China, and protectionism is predominantly addressed at China. So how do you see that side of the happily harmonious Asian story?
Well, I presume I have 60 minutes.
You have 1 minute precisely.
Well, I presume I have 60 minutes.
You have 1 minute precisely.
First a comment, very important comment what you said about government, okay? I mean, the thing that is almost inconceivable in a room like this is the fact that China today may have the smartest government in the world, the most competent government in the world. I mean, if you look at the quality of mind of people in Chinese government, the meritocratic selection processes, it's quite remarkable. And that's why China has sailed through this crisis better than other countries. Why? Competent economic management. And the big shift in Asian minds, by the way, is that whereas in the past they used to automatically copy the West, now they're saying, hang on a second. You look at the West, they're going exactly the opposite of the advice they gave to us in the Asian financial crisis, rescuing failing banks and so on and so forth. So the shift in mindset of the Asian mind away from the Western mind is an important one. Now on this question of infrastructure, now the remarkable thing about the Asian story is that there is not one Asian story. There are, as you said, many Asian stories. There's a China story, there's an India story, there's an Indonesia story, there's a Vietnam story, and you have to understand each story on its own basis. They look at India. They haven't had the most stable government, right, the last 5 years. But guess what? Before the current crisis, look at Indian growth rates. Without the kind of good governments that China had, India still managed to get high growth rates. Why? There's something in the system that's working, right? And I can tell you, when I was in Delhi, in Chennai in December, I asked them, how is India going to react to this great crisis? He said, wonderfully. I said, why? He said, this crisis brings chaos. We in India were used to chaos. We will enjoy it. But the last point about the harmonious Asian story, okay? You're right. I mean, whenever you have new rising powers, you will have geopolitical tensions. This is inevitable. But what's remarkable is that up to now, you have the exact opposite happening. You look at Southeast Asia and China. The region that should fear the rise of China the most is Southeast Asia, right? Guess what? China signs a free trade agreement with Southeast Asia. You have the greatest explosions of trade taking place all across East Asia. There is an awareness in many Asian policymakers that if they waste this moment of history, they're going to waste a century or more. And that's why most Asian minds today are focused on how do we get out of this crisis, how do we keep growing very fast, and how do we ensure that despite what the West does, we carry on still.
Jeff, did you want to comment either on protectionism against China or particularly India?
So I'll just maybe address a little bit of the question on infrastructure. You know, it is the difference between China and India so far. I visited the earthquake site it's about 2 hours out of Chengdu last summer. And right up to the point where the earthquake devastated the Chinese landscape, I was on an 8-lane highway, which would have been the best road in all of India. And this was way outside of a major tier 2 city in China. So I think the way Kishore described it is right, is that Chinese government is probably the best in the world. They've worked on infrastructure first. They've made it a tremendous competitive advantage. And the management team has to catch up in China with how good the government is. India is just the inverse. You've got this great entrepreneurial class, global CEOs inside India, and the government will have to catch up to the economic structure in India. I think India now is to the point where the government cannot stop the economic force that exists inside the country. And I find the last election to be particularly encouraging in terms of what's going to happen long term inside of India. Infrastructure, I'd still be long your infrastructure fund. I would still be long your infrastructure fund vis-a-vis India. I still think there's going to be lots of investments. The last thing I'd say about India, still the danger of too much corruption on the infrastructure projects, maybe not nationally, but inside the states. On SMEs, Martin, look, SMEs are important to GE. We've got a big supply chain. The fact of the matter is that the banks that have gotten all this bailout money in the UK and the US haven't been the banks that SMEs had relationships with in the first place. And so I think one of the travesties about this is that, you know, the big industrial base really has been the ones that have been dealing with finance companies or small banks. And this has got to be one of the real focus areas of financial services coming through this crisis. You know, these were not relationships that were driven by JP Morgan or B of A or Citigroup. These were relationships that were with Fifth Third Bank in Cincinnati or with GE Capital or other financial service businesses like that.
I think that's certainly true in the US. It's probably a bit less true here, where we unfortunately have a very oligopolistic banking structure, which has just got much more so. The lady over there, who I promised to have, I'll take one more question, that'll be it, because I've been told I will be shot if we don't finish at 11. Please.
My name is Elizabeth Scott, and I'm a student on the Scope Fellowship Programme at London Business School at the moment. My question is really picking up on something that Bill Davies has said about how quiet he's found the voice of business in Britain today. And Jeff Immelt's point about government moving next door, and they're not going to go away anytime soon. And I was just wondering how the panel would square that particular circle, and to what extent business should be thinking about raising its voice in the current turbulent economic climate.
Fine. And one final question. Was somebody here at the front? Yes. Stand up. And can you bring... And that'll be it, I'm afraid.
My name is Fernando Diaz. I'm at London Business School. We just had our 10-year reunion, the 99 body of alumni, and this past weekend. And I was interacting with some of the students here, and there's a lot of questions about, you know, which way to go, what kind of jobs, what kind of opportunities, and asking us, well, what would you do if you were in my place doing the school right now? So that's my question to you. What will you do? What are the opportunities you think for young graduates of such an institution to actually grasp the opportunity that you've been talking about for the next, say, 10 years?
I'm going to start with you on that one, because it seems to me at a time like this, you're in exactly the right business.
It is a good business.
In many ways.
I would advise any student going into the workplace to seek out a business or an opportunity that gives you global access. The world outside of the UK, it's outside of Europe. Europe offers important markets for us, for sure, but I think the real career possibilities are for those who are prepared to experience the real pleasures that markets such as Asia, South America have to offer. And I think for those who do not wish to seek those opportunities, you will put yourself into a much smaller pool of opportunity. And if I may, the one thing I would say on government, there are certain businesses that are very, very vocal with government, and we need some others to help us.
I think the banks have been doing fine myself. Ian, on either of these questions, the voice of business and even more, what would you advise people to do now apart from joining McKinsey?
Well, I think as Jeff said, this is a bad time, but it won't always be a bad time. And once, my own view is once people adjust to the new normal, whether it's bad or good, I think you'll see employment coming back. I think we're in an adjustment period. My only advice to people looking is do something. If there aren't the opportunities you want in investment banking or entrepreneurship, teach, go into government, even do something, and then that gives you the platform to get back into. So drifting around, I think, is not good. And if it means doing not quite what you would have wanted 2 or 3 years ago, do something would be my advice. Also get in there, and it will change. I think the spokesman for business, I think, is a very, very hard one. And the reality is, and I can say this being slightly on the outside, is there's nothing in it for leading businessmen to speak up, and there's a lot of downside. I mean, Jeff, I don't want to talk to people, when a big business gets up and talks about things, you know, the cynicism and the opprobrium and the media attention you get, it's not in the interest, not just the individual, but of the company. And so you need some sort of collective mechanism, yet we all know what business associates as a sort of dead hand of anything interesting being said. And somehow I think there needs to be a much better dialogue between government and business, whether you do that. Somehow I think the media has to sort of try and take a little bit more, as I hope the statement I'm saying, but I'll say it anyway, just try and give businessmen a little bit more out without trying to attack them as though they're somehow representing the devil. But I think it's very important to understand that business creates 60–70% of world employment. It provides the product and services on what the world depends, much more than banking or government. And yet, it's met with cynicism somehow. This is my incentives point. There needs to be an incentive for business to speak up, and that's just lacking. And the only advice you can give to leading businessmen is, you know, do it some other way. I'm sad to say. I think it's a terrible situation, and I think we do need more Richard Bransons who are not Richard Bransons. They need to be more human. You know, like the rest of us. I mean, he's human. So I don't mean he's human, but he's special. We need ordinary people who can represent ordinary people, not gifted geniuses or entrepreneurs.
I think cloning Richard Branson would be hard. Mervyn, business representation. Do you want them beating down your door?
No, I do think we're going through a period of talking Britain down, and I make no apology for saying this wherever I go. I think we've got great innovation going on, great science, great universities, but more importantly, we've got a very diverse economy that I mentioned in my speech, and I think we need to celebrate that success, examples of SMEs, examples of big business that have done well, and we need to be less fragmented. We need the media to showcase British success, and we need the media to allow the voice of business to appear in the media without them attacking the individual for saying that. And if we don't have that openness, then I think we will miss the trick. And I think the advice for anyone starting in business or looking for a job, just be open-minded and be international. And don't just go for the market. You know, there's danger that everybody piles for China, everybody piles for an industry, but history will show us that actually just be open-minded, be international.
Do you want a last word, Jeff?
You know, I would, on both the questions, Martin, you know, I would say, you know, running GE is a full-time job. I can tell you, especially the last 9 months, you know, I probably had, if I include weekends, maybe 5 days off in 9 months. And so you are thinking about it all the time. Now, with that said, look, there are important issues where business has to engage. You know, GE was a founder of the U.S. Climate Action Partnership to try to engage with government on some kind of energy policy. You know, why? Because it's better that we're engaging in things like that than that we pretend like the status quo is just going to take place. The U.S. needs healthcare reform. Business should be a part of that, or else they're going to, you know, get left behind. And I think in the end, look, I own a media company. Sorry, guys, they don't care, you know. And so I just think you better be comfortable with yourself. You better be comfortable getting criticized. And you know what? Just to hell with it. I just say to hell with it. And I just don't. We go as a company where we go, and I'm just not going to let the business media define who I am or who this company is. I don't care. Now, for business school students, guys, you have been a lagging indicator on every great trend that's happened in my lifetime. I graduated from 1982. 25 people from my graduating class from business school went to work at Atari, the video game company. It was out of business 3 days later. You show up at private equity too late, you show up at investment banking too late, you show up at consulting too late. And my advice to people is, look where the lines are longest on recruiting day and go someplace else. And just do what you like. I mean, I'm passionate. The thing I love about GE is we're going to be in the front seat of history. The thing I love about my company is we're going to, whether it's China, or renewable energy, or nuclear power, or affordable health care, we are going to be in the front seat of history. So in the end, I'd say, come work for us.
Here, and if I last another minute, I'll be shocked. I'll just make 3 conclusions from this panel. First, the rumors of the death of capitalism have apparently been exaggerated, or at least it's postponed. Second, the conclusion of the panel is you should all go east, and the provocative subtext of the panel is that since that's the consensus of the panel, it must be wrong. So stay at home. Your best future lies in Britain, and nobody will deal with this. Or wherever you come from. If it's in the East, of course, you're going back there anyway. And the third point, I must make this point, since everybody attacks the media. The media, I'm afraid to say, are also a business. And the users of the media don't like these happy stories. And the users of the media, the readers and the viewers, are you. So I'm afraid it's not our fault. We just deliver what the market wants. Thanks, panel.